Usually when you look at a stock ticker, you're buying a piece of a company that makes a physical product.
Right, yeah. Like you can see cars rolling off an assembly line.
Exactly.
Yeah.
Or you log into a software platform and you understand exactly where the profit comes from. It's tangible.
But step into the world of corporate finance and asset management, and that linear relationship completely vanishes.
It really does.
Yeah, the product isn't a widget anymore. The product is capital. And untangling how that money actually generates returns requires a completely different analytical toolkit.
So today, we are taking a crowbar to Main Street Capital's Q2 2026 earnings call transcript. We're doing a deep dive into the numbers, and we are going to translate the Wall Street jargon and give retail investors a highly actionable breakdown of whether this stock, ticker symbol, MAIN, is a buy, hold, or fold.
Let's do it.
Okay, let's unpack this. Starting with the headline data from the second quarter. The top line is absolutely growing. Total investment income hit nearly $150 million. I think it was exactly $149.6 million.
Right, which is up 3.9% year over year.
Yeah.
And, that growth is being driven by higher interest and fee income. But in this sector, you really have to look at the underlying asset base to see the full picture.
Which brings us to the net asset value, right? The NAV.
Exactly.
They hit a record high of $33.92 a share. That's a 1.4% increase from just Q1.
Which is huge. And when you combine that asset growth with their actual income generation, you get to an annualized return on equity of an incredible 18.9% for the quarter.
Almost 19% ROE.
Yeah.
That's wild. But wait, hold on. Let me push back on this for a second.
Okay.
Because I was looking at the distributable net investment income, the DNII.
Right, the actual cash they can hand out.
Exactly, the cash they can hand out to shareholders. That came in at $1.08 per share. But that is actually a 3-cent drop from Q2 of last year.
It is, yeah.
So if assets are at a record high and they're pulling a near 19% return, why did the actual cash drop by 3 cents? Like, that feels like a massive disconnect. Is that a red flag?
I mean, on the surface, you might think so, but what's fascinating here is that when you peel back the layers, it's not a red flag at all.
Okay.
It actually highlights the healthy volatility of their business model. So the slight year-over-year drop is primarily due to a decline in non-recurring dividend income.
Non-recurring, so like one-offs.
Right. Think of those like special, unpredictable bonus payouts from the smaller companies Main Street invests in.
Okay.
Last year, they had an unusually high number of those special payouts. This year, they had fewer, and they also had some increased cash expenses this quarter.
So the year-over-year comparison looks soft simply because they didn't get as many surprise bonus checks.
Exactly. It's not because the core engine is failing.
Got it.
And if you look at the sequential data, their cash earnings are actually up 4 cents from just last quarter. So from Q1 to Q2, it went up.
Okay, that makes way more sense.
Yeah, the core interest and fee income is easily making up for the lack of those one-time payouts.
Well, the numbers definitely look solid on the surface, but to know if this is actually sustainable, we need to look under the hood at exactly how Main made this money right.
Absolutely.
So I keep seeing the acronym BDC attached to Main Street in these transcripts. Translate that for us. How is a BDC actually different from a regular bank or, I don't know, private equity firm?
Sure. So a BDC is a business development company.
Okay.
It's a specialized vehicle literally created by Congress decades ago to help small and medium-sized American businesses get capital.
Because big Wall Street banks ignore them.
Exactly. The big banks don't want to mess with a company making $20 million a year. It's too small for them. So Main Street focuses on what they call the lower middle market.
Lower middle market.
Right. These are regional logistics companies, specialized manufacturers, or local IT providers generating anywhere between $10 million and $150 million in revenue.
Okay, so think of Main Street like a mix between a highly selective local community bank and an aggressive venture capital firm.
That is the perfect analogy.
Right, because they lend the debt to protect their downside, so they get those regular interest payments.
Right.
But they also take an equity slice of the pie to ride the upside.
Yes, and that dual structure is their entire secret sauce.
Because most banks just take the interest and that's it.
Exactly. If the company blows up and goes public, a regular bank just gets their original loan back, but Main Street gets to cash in on the equity.
Wow.
And this quarter, That equity strategy paid off in a massive way.
The Center Technologies deal.
Yes, the Center Technologies deal. They fully exited their equity investment in that company and recorded a $46.4 million realized gain.
That is a huge number for a company this size.
It's staggering. It is an 8.8-fold return on their original equity investment.
8.8 times their money.
Right, which translates to a 40% annualized internal rate of return.
40% IRR. That's VC numbers.
It is. And the craziest part is it's not a fluke. On the call, management highlighted past exits, like KBK Industries, that delivered a 127% annualized return.
127%. That is absurd.
Yeah, so when they pick winners, the equity kicker goes to the moon. And it drove the broader income numbers up across the board.
Yeah, let's look at those numbers. Fee income jumped 81% year over year to $9.5 million.
Mostly due to elevated refinancing activity, yeah.
And then interest income rose 12% to $112.6 million.
Right, because rates are higher.
But that was offset by dividend income dropping 28% to $27.4 million, which we kind of touched on earlier.
Yeah, that drop is due to portfolio exits like Center Tech and just capital allocation decisions by the underlying businesses. They didn't declare as many special dividends.
Okay, so here's where it gets really interesting for me.
Okay.
Because while those wins are huge, the CEO, Dwayne Hyzak, he explicitly warned on the call about a widening gap between their overperforming and underperforming portfolio company.
He did.
He cited economic uncertainty, inflation, rates, the usual macro stuff. So should retail investors be sweating about a wave of defaults, wiping out the bottom line? I mean, these are smaller companies. They're inherently more vulnerable.
That is the idiosyncratic risk of this market segment. You're completely right. Smaller companies have less margin for error.
Right.
But management handles this with a ruthless, and I mean ruthless, don't put good money after bad philosophy.
Meaning they cut them off.
Exactly. If a business model is fundamentally broken due to market shifts, Main Street stops funding it to limit their downside exposure.
They don't try to save a sinking ship.
No, and they take the hit and move on. And the proof that this works is in their non-accrual data.
Non-accruals being the loans where the borrower has stopped making payments?
Right. It's essentially their default rate. Right now, that sits at just 1.1% of the total portfolio's fair value.
Wait, 1.1%? In this rate environment?
Yes.
That is incredibly healthy.
It's remarkably low. It shows their underwriting on the front end is extremely tight.
Okay, so they've built a fortress around their current assets. But so what does this all mean for the immediate future? How does this hold up next quarter when they have to start refinancing their own debt at today's higher interest rates? Let's pivot to management guidance for Q3.
Yeah, let's do it. Management was very transparent here. They warned that we will see a temporary squeeze on margins in Q3.
Because of the borrowing costs.
Right. They project the distributable net investment income, that cash earnings number, will drop to at least 97 cents per share.
Down from the 1.08 this quarter.
Exactly. And the why behind that is driven by two main factors. First, that expected decline in non-recurring income we talked about.
Right.
And second, higher costs of capital. A massive block of their cheap debt matured in July 2026, and they had to issue new notes to refinance it.
And I'm assuming those new notes were not cheap.
Not at all. They priced at nearly a 7% interest rate.
Ouch. Yeah, that's going to eat into the spread.
It does. Combine that with a pipeline for new investments that the CEO characterized as merely average, and you get that softer 97-cent guidance.
But, and here is the massive payoff for retail investors.
Right.
Despite that softer Q3 guidance and despite the rising borrowing costs, management still declared a 30-cent per share supplemental dividend for September.
Yep.
And this blew my mind. That is their 20th consecutive quarter doing a supplemental dividend.
5 straight years of bonus checks for shareholders.
Plus, they expect to propose another one in December. And if that wasn't enough, they raised the Q4 regular monthly dividend by 3.9%. So it's up to 26.5 cents a month.
Which is huge. That dividend raise is the ultimate signal of confidence.
It has to be, right?
Yeah, I mean, you don't hike the permanent recurring monthly dividend unless you are absolutely certain your core cash flows can support it long term, even with those higher borrowing costs kicking in.
Right. They wouldn't raise the baseline if they were worried about the 97-cent dip being permanent. So time to make the call based on all this data. Are we bullish or bearish on Main Street Capital right now?
I mean, I lean heavily bullish, especially for income-focused retail investors.
Oh, totally.
If we connect this to the bigger picture, it all comes down to balance sheet defense.
Explain that.
So their regulatory debt-to-equity leverage ratio is sitting at 0.69 times.
0.69.
Right. And their own target is 0.8 to 0.9.
Oh, wow. So they are significantly below their own allowable limits.
Yes. They are playing it incredibly safe. They are not overexpended.
Which means they have a ton of dry powder if the economy actually does tank.
Precisely. On top of that conservative leverage, they are sitting on a massive $1.2 billion liquidity cushion.
Billion with a B.
With a B. And they operate this entire machine with an incredibly lean operating expense ratio of just 1.3%.
1.3%. That's lower than some ETFs.
It is. They are highly efficient, conservatively leveraged, and sitting on a pile of cash.
So the actionable takeaway is this. If you hold Main, you just sit back and enjoy the absolute flood of cash being returned to you via regular and supplemental dividends.
Pretty much. Yeah.
Because the Q3 dip to 97 cents EPS is clearly just a minor borrowing cost speed bump. It's not a structural flaw.
Not at all. And as their president, David Magdal, clearly stated on the call, they fully expect their future realized equity gains to exceed any future credit losses.
Right. The center techs of the world will easily pay for the 1.1% that go bankrupt.
Exactly. The math works heavily in their favor.
It's an incredible story of yielding high returns in a really murky market. But before we wrap up this deep dive, there is one detail sitting quietly in the transcript that I think hints at the future of this company.
Oh, the asset management side.
Yes. Main Street has an external investment manager. Basically, it's their own internal asset management arm that runs private funds for institutional investors.
Right. So people who aren't buying the public stock.
Exactly. And this private side already has $1.8 billion in assets under management. It contributed $8.7 million in pure fee income to this quarter's net investment income.
And they are gearing up to launch Private Fund Third later this year or early 2027.
Right. And they're expecting it to be their biggest one yet.
Oh, easily.
So it leaves you with this provocative thought, right? If retail investors in the public BDC are seeing 8.8-fold returns on equity investments like Center Technologies,
yeah,
how massive is the untapped wealth being generated behind closed doors in these exclusive private funds?
Right, where the fees and the structures are totally different.
Exactly. Will Main Street's asset management sidekick eventually outgrow the core business and become the main character of the company's growth story?
It's definitely something to watch.
It really is. It's a fascinating dynamic for a company that already dominates its space. Yeah. Something to chew on as we watch this financial engine keep running.